good defensive investment portfolio is not meant to necessarily replace growth assets, but a good defensive investment portfolio should be designed to complement growth assets. In my mind, a well-designed or a well-constructed defensive portfolio should give investors and their fiduciaries the confidence and also the capacity to take risks in other parts of their portfolio where they're better rewarded for taking risks. The good defensive investment portfolio probably has four main objectives. Firstly, a good defensive portfolio should give investors a high level of capital security. By that I mean low levels of price risk, low levels of volatility, low levels of drawdown risk. Secondly, a good defensive portfolio should provide liquidity. It should give investors access to funds as and when they require them. Thirdly, a good defensive portfolio should ultimately give you income, and that income should be predictable, it should be consistent, and hopefully it should be better than cash. But also importantly, a good defensive portfolio should bring more balance to portfolios. It should provide a complement to the other risks that you hold, and as such I think a good defensive portfolio should provide low correlation to traditional listed equities in a portfolio. One of the questions that I'm asked more often than not in my role is certainly how do you ensure when you do allocate to defensive investments that those allocations perform defensively, and particularly at the times that you need it. I think there's a variety of potential investments there, but I've tried to boil them down to three. And I think firstly you can look at cash as an eligible investment, and within that landscape or universe I'd include term deposits. Secondly, you can lend to governments, sometimes called sovereign debt, albeit that relationship's being tested a little by some Southern European borrowers at the moment. And the third option that you've got for defensive attributes is lend to non-government borrowers, which is sometimes referred to as investment grade debt. It's really important though, if you're expecting defensive attributes from that part of your portfolio, that investment grade debt is of a high credit quality and by and large of a short tenor. What I really mean there is the more risk you take in introducing a lower quality of borrower or a longer dated loan in your portfolio, the lack of visibility to returns. And as such, you may be introducing some of the risks that you're actually trying to avoid by introducing those high yield securities to a portfolio. I think fixed income plays a defensive role in a portfolio for a variety of attributes, but I can probably summarise them in two main ways. Fixed income securities or bonds, or sometimes as we refer to it at perpetual loans, are fairly unique in investment markets in so much as bonds mature. And what a maturity date provides is a fairly predictable investment outcome in so much as it gives investors a known point of time as to when their capital is being returned, and it should give them a fairly known outcome in terms of what their return on that capital will be. Secondly, by their nature, bonds are ranked further up a capital structure than other types of securities. What I really mean by that is bondholders get paid their coupons before shareholders get paid their dividends. And in the event of a company going into distress, shareholders lose their equity before bondholders contribute their capital. Another way of saying that is we get paid first and we lose last. And I think it's those two criteria of maturities and security through the capital structure that's fairly unique in investment markets, and it certainly provides visibility to outcomes and predictability to returns. I think one of the consistent things that you'll come across when discussing investments at Perpetual is our focus and our resolve on growing and protecting the capital of our clients. And growing, and for that matter preserving capital, is aided in part by minimising the chance of losing it. So Perpetual, whether we're investing capital or we're lending capital, we're very much focused on ensuring we do so in quality businesses, and we lend to those businesses or invest in those businesses at attractive levels of yield or attractive levels of valuation. At Perpetual, our fixed income strategies are first and foremost focused on delivering to the attributes that we expect clients want from fixed income, i.e. great levels of capital security, meaningful levels of income, and great levels of or access of liquidity. But in doing so, managing a disciplined investment process on focusing on risk, given that really the upside with a bond or a loan is getting your money back, the downside is much more severe. It's a little known fact that Perpetual has actually been lending capital for as long as we've been investing capital. We've been lending since 1966 for as long as we've been managing shares in our industrial share fund. And our experience and investment team has very much been focused on ensuring we can add risk to portfolios when we're being rewarded for it and protect capital when we see conditions deteriorating. We're focused on providing the attributes that our clients expect, and our investment process is managed accordingly. We build our portfolios focused on the return of our clients' capital, not necessarily the return on that capital.
The fixed income market consists of two main components: the government bond or sovereign debt market and corporate bonds or credit. Sovereign bond yields are often used as a proxy for the risk-free rate of return for an investment. When investing in corporate debt, credit investors are able to earn a yield or credit premium to compensate them for the risk of default or the probability a corporate borrower can't repay its debt when it falls due. When investors are allocating to fixed income, we understand that they're looking for capital stability, liquidity and predictability of income. That's why when we lend to companies or invest in corporate bonds, we're looking for companies with similar characteristics. Companies with predictable earnings, a strong balance sheet, capable management who are able to execute on strategy, companies which operate in leading positions within their industry, and companies which have low susceptibility to political, regulatory and event risk. When lending to high quality borrowers, history has shown that credit premiums overcompensate for default risk. This raises the question, why? The credit premium compensates investors for three key risks: default risk, or the risk that a company is unable to repay its debts when they fall due; liquidity risk, or the cost of transacting in the bond market when you cross the bid-offer spread; and uncertainty risk, or the inability to be perfectly diversified by holding every bond in the investment universe. Recent history has shown that this overcompensation for default risk is greatest during periods of market stress. One reason for this is the heightened volatility during periods of stress lead to reduced liquidity, offering long-term investors the opportunity to capture the additional liquidity premium during these periods. Fixed income investing is about predictability, and it's characterised by a risk-return asymmetry. Risk-return asymmetry describes investing where you experience frequent but modest returns with the potential for infrequent but large losses. Or put more simply, when purchasing a bond, the upside is determined at the yield at which you've purchased the bond, but the downside could be your entire invested capital. For this reason, it's very important to be well diversified when investing in fixed income, and a well diversified portfolio would typically have between 1 and 200 securities. At Perpetual, we manage for these investment risks. Our investment process focuses on building high-quality, well-diversified liquid portfolios. This generates the defensive attributes investors are seeking and offers a competitive return. The Diversified Income Fund is a floating rate portfolio with low interest rate risk, but offering investors the upside of a rising interest rate environment. The portfolios are domestically biased, which reduces hedging risk and improves the consistency of income. The portfolios are high quality, predominantly investment grade senior debt, again reducing volatility and increasing liquidity. The portfolio has a low correlation with equities as we lend for short periods of time, reducing volatility. Finally, the portfolio is actively managed for risk, generating the defensive qualities investors seek whilst offering competitive returns.
As Vivek mentioned, the Diversified Income Fund from Perpetual is what I'd call a high quality, short duration credit fund. And as much as saying it's a great complement to many investors that are using other types of defensive investments in their portfolio. In fact, I think it's a great complement to investors that are making or using term deposits. If they're comfortable lending to a bank, maybe they'd consider lending like a bank, which is effectively what the Diversified Income Fund does. Many other defensive investors use traditional bond funds that may have exposure to what's called duration risk or interest rate risk, and many hold exposures to government bonds. So the Perpetual Diversified Income Fund is a great complement to those traditional bond funds with a balance of different risks. And thirdly, I think in my experience, we're seeing a lot of investors taking direct exposures in high yielding, more subordinated securities, another way of saying hybrid securities. And as such, the Diversified Income Fund is a great complement as a high quality core to offset those high yielding direct securities in a portfolio.